So the CUSUM is a cumulative sum. That's what the CUSUM stands for. It's a method designed by Marcos Lopez de Prado. Marcos Lopez de Prado is a portfolio manager at Abu Dhabi Investment Authority. He also is a professor of practice at Cornell University. He has a very extensive experience. He was at the AQR, a very well-known hedge fund, and has a long history. And also a friend of mine. And he is the person who wrote the first book on machine learning in finance, and he is an authority on a lot of these things. So Marcos came up with this method, which I'm going to explain to you. He runs a fund at ADIA, and my suspicion is that it's a great fund. My suspicion is that it uses some of these methodologies, but I'm sure it's not exactly this methodology. In fact, as you will see, this methodology is a very good foundation to create your own. It's an unsupervised method, and a critical aspect of it will be the labeling part. We will have the algorithm label the data set that we will be generating. It's an unsupervised method to create an optimal trading strategy. And the optimality is something which you can define. We're going to see one, but there's many different variants. And I'll try to give a very broad description of what it is, because it is very adaptable to many different situations. In fact, someone here was telling me that you're trying to design some method to do fundamental trading for cryptos, I think it was. I forgot who, maybe it's online. Someone, one of the great conversations I have had this day with some of you. So things like this way of thinking could be very, very useful in that context. Okay, but as I remind you, this is in machine learning in finance, where you will never find this a successful method that looks at the past and said, "Oh, I know what the market is going to do tomorrow." No, you cannot know that. Okay, that at least no one has found out how to do that. What this method will do is will give us a way to think about the data that we have. And one critical aspect of this is the concept of downsampling. The method is built on a premise, which is that too much information is going to train your data in the wrong way. So it's going to train your algorithm in the wrong way. So we have to figure out what information is relevant to use into my unsupervised learning framework. Okay, and the concept here is downsampling, and there is some justification for that, which is that if you sample at the same frequency, if you sample all of the data which you have in front of you, that is going to be prone to making mistakes. The markets have their own clock in terms of how information is brought into the markets, and you don't know what it is. And the first aspect of that is how the downsampling is brought into this. It's a way to reduce the amount of information that goes into our machine learning algorithm. For that, we're going to be using certain metrics, which are called the information bars. So the information bars are going to be a way for us to decide when information is relevant. And there's many of them. Time bars, tick bars, volume bars, dollar bars. And yesterday we focused on one. That's the only one that I'm going to be doing in this course, is the tick imbalance bars. But there are others. And again, if you're interested in this, I encourage you to go through maybe all of them, or the one that may be most useful for your particular application. So I'll focus on only tick imbalance bars. And the way the tick imbalance bars is built is as follows. Okay. We are going to look at the information given to us by the market, and I'm going to create a series of numbers which are going to be only +1 or -1. Every time there is a tick, every time there is a trade in the market, I will assign a number +1 or -1 to that tick. We're going to label every tick. If the price goes up by whichever amount, I label that tick with a +1. And if the price goes down, depending on the amount, I label that tick with a -1. And if the tick has exactly the same price as before, I keep the previous price. Sorry, I keep the previous value, +1 or -1. So it's a sequence of only +1s and -1s. It ignores the size of the price jump. It only looks whether it goes up or down. And if it stays the same, it's not zero, it's just equal to whatever was there before. A sequence of +1s and -1s. Then the tick imbalance is something which will be created over time as the accumulated value of those numbers. So I collect the +1s and -1s, I add them up, and I see how large this tick imbalance is going to be. So you're going to have a sequence of +1s every time there is a continuous sequence of price increases. You have a sequence of -1s every time you have a continuous sequence of price decreases. Or, okay, if there's no price change, then it just takes whatever value was there before. And the cumulative sum of those imbalance bars is the cumulative tick imbalance bar. It represents the cumulative direction of trades. The idea is that if buyers dominate, this number is going to grow positive because price will tend to go up. If sellers dominate, this number is going to go negative because sellers will dominate. And this is, we saw this graph yesterday. That's not the one that I was missing, but I will explain it better now. What we see here is the first actually the first second. In the first second here, we have a number of trades. That's the first second. We have a number of trades, and we can see that they sell pressure on those trades. And then at some point, we see that there is a change of pressure, and there is buy pressure, and the tick imbalance goes back up. This doesn't mean that the price goes back up. Remember, this is the sequence of only +1s and -1s. Okay? So if the buyers are lucky and they buy cheaper, or if the sellers are lucky and they sell higher, we're not looking into that. We're only looking for the direction of the market, like that. Now, important things happen when we hit a certain threshold. So there is a concept of a threshold, which I will describe to you how it's done. This is the part I was missing yesterday, okay? The description of the threshold. The threshold will be, in this case, is the +15 -15. I'll tell you how we came up with that number. And when the -15 is hit, see what happens. At that point, I will declare something. I will declare that important information is in the market, and I will take certain actions, which I will decide. I will tell you later. I will make certain actions, and I bring my tick imbalance bar to 0. So at that point, I unwind my tick imbalance bar. I say, I already used that information. I'm going to label that particular price in a certain way. That's how the unsupervised learning strategy will be created. I will label that in a certain way, and then I start fresh, looking at the at the balance between buyers and sellers. And you can see that in this example, I have 13, 26, 27, 19, something. What? Oh, yeah. So I have 6 seconds here, right? 1 to 6 seconds. So in 6 seconds, I have three, 1, 2, 3. I have 3 observations that matter to me in this example that we have here. Okay? There's probably, I don't know, 100 traits in 6 seconds. I only look at 3. These are the 3 that I consider to be significant, and I will label them in a certain way. This is what's called downsampling. I am not going to look at all of the data given to me. It will be potentially misleading, not interested. I consider these to be only the ones that are relevant. Okay? And this is predicated on my choice of a threshold, in this case, minus 15, plus 15, which will tell me that when the imbalance hits that level, there's information in the market. Everything else is noise. And I ignore it. Okay. I don't have mathematical proof of anything. I'm just describing you the CUSUM methodology. All right? So I have the cumulative imbalance in blue and the positive and the negative thresholds, which I haven't told you yet how we're going to do. Okay? The positive and negative threshold are constructed as follows. There's a formula for that. The threshold is the multiplication of the expectation between the expected value of my imbalance times the expected time it'll take me to get to that threshold. Okay, so this is an important step here now. Today, right now, when I have my algorithm running, my algorithm demands that I have a certain expectation of 2 things. The time it will take me to hit the next threshold and the expected imbalance, which is what's there. How do I know that? I know that from the history that's given to me in the past. Footnote. I read that, how do you do that? I read that one method to do that, that some people use, maybe even Marcos uses himself, is to use exponentially weighted moving averages. Now, I already told you that I'm against the use of exponentially weighted moving averages because it's a concept that does not correspond to any mathematical object. It's just a formula. So at this point, I'm not concerned with that. How you calculate the expectation, that's where the different implementations of this algorithm will work. Okay, so some people will use exponentially weighted moving averages. Other people will use some fancier probabilistic or stochastic process to estimate what that is from past series. Some people will use some machine learning method for that. You're completely free to calculate that expectation in any way you want. Okay, but that is my expectation at this time of the time to hit my my hitting time, my expectation of my hitting time and the expected imbalance. And how you do that, that's wide open. If you want to use exponentially weighted moving averages, although I recommend it against their use, go ahead and use it. This is not something which, and who knows, maybe this is this is an unsupervised learning method. Maybe it works, and maybe the supervision will actually cure whichever defect comes from the use of exponentially weighted moving averages. Okay, so I'm not specifying how you calculate those expectations. All right, so this is the expectation, and then I will define the hitting time or as the the heating time. This is the real heating time. This is not the expected heating time. I will define the heating time for my next step as the time I hit my next threshold, which is that. Okay? And this is the graph that I was missing. This is the graph that explains how I do that dynamically. So I start now. Let's say that these are my ticks. In the first, 100 ticks, I can see that I've hit my threshold 3 times. Every time I hit my threshold, I recalibrate my method. So I recalibrate my expected time to hit the threshold and my expected imbalance. That gives me a different threshold. You see the thresholds here are different all the time. And when I get here, this is very dramatic, suddenly the thresholds become very, very small. And I hit the threshold very often, and almost every tick becomes part of my database. So here I ignore a lot of information. My algorithm is telling me that a lot of my information is noise. Only a few of those traits are significant. But at some point, because of the way the algorithm is built, I have very frequent use of the information that's given to me. So this is downsampling. This is the way I go from tick by tick data, which is very intense and full of noise, into a subset of that, which is what this methodology regards as significant. Okay, so again, whoever it was that was talking to me that you were going to build some algorithm to trade. I forgot who it was. Sorry. It was you? Okay, so thank you. Your name? Ilya. Ilya, I-L-I-A. Ilya, okay. So this is how he approaches that. It's a way to distinguish the music from the noise. It's a big ambition of humanity, okay, to understand what's relevant and what's not. So that's the way it does it. So going forward, we're only going to be focusing on those price points where we hit that threshold of significance. Okay, this is the downsampling part of the methodology. There's 2 parts. Only this is the first one. Is that clear? Okay. If you're asking me why does this work, I don't have an answer. I don't know. Because I'm going to now go to the supervision, to the labeling that would lead to the creation of my machine learning algorithm. And then I'll let the machine learning algorithm tell me how to make this work. Okay, so this is the way I do the downsampling. Now I go to the labeling. We've decided now when to look at the data and which data to bring onto our training database and which one to simply ignore. That's what we have done so far. The next stage is going to be to decide what that means. And this is where the unsupervised algorithm starts. What I'm going to do is I'm going to label each of those price information points in a certain way and then feed it to an optimization algorithm to tell me what the meaning might be. So what I have here is that there is 2 approaches, dynamic labeling and advanced labeling. In the notes, I have both, but today I'm only going to focus on the dynamic labeling. I will leave that there and the rest you can read. In fact, I'm giving you maybe 10% of all of the possible combinations that exist. I'm only looking at tick imbalance. I'm not looking at dollars or volumes. So I'm only giving you a slice of this. I'd rather have you understand how one of these algorithms work, and then the rest, if you're interested, you can replicate by using different variants of different consumed quantities. Okay, I want to focus just on that. And the label, when I have a price given to me as significant, The label is going to be an attempt to tell me if I should be buying, selling, or doing nothing. That's what the objective of my label is going to be. And you can come up with other labels, by the way, but the one that I will describe here in this is that a buy signal, is that a sell signal, or a do nothing signal? That's all. That's only 3 labels I'm going to do. The advanced label, I'm not going to, it's explained in the note, but I'm not going to present it here. And the way the labeling works is, I said buy, hold, sell, only 3. And it's done as follows. What I'm going to do is I'm going to decide if it's a buy signal or doing nothing by looking forward. This is a method that is built with the benefit of hindsight. So I'm going to look forward a number of observations, which I call here H. H is the number of bars I look forward. Okay, so again, H is at this point we're changing our watch, and we're not going to take observations at equal amounts of time. The amount of time at which we take observations is dictated by the ticking balance. Sometimes it will happen very frequently, sometimes it will happen very infrequently. It's not a time homogeneous algorithm. Okay, so I look H number of bars ahead, and then I see that if my return exceeds a certain threshold, it's a buy signal. If my return would have exceeded a certain threshold from the below, it would have been a sell signal. And if it stays in the middle, it's a do nothing signal. Okay, so this is decided by looking forward. Okay. And the labeling is done, and the labeling is done in 2 directions. It's done in the direction of me looking forward, which is denoted here by the number I, and the number of I's that I have is represented by a label set, which is capital I, is how many times in the future I look. But then I allow some feature space to be there also that can add to the labeling. And whatever the feature space is, it could be past returns, it could be volatility, it could be order flow, it could be volume, it could be technical indicators. It's whatever you want to feed to your system. It could be the behavior of world markets. It could be news. It's up to you. You can bring that into your method. It's a very flexible method. You decide what the features are going to be, which will be part of your labeling system. And once you have that, this gives you an algorithm, an unsupervised learning algorithm that you optimize and you train your system to tell you what the right label will be when you go into the testing or the application data set. Okay? That's all I wanted to tell you. So it's very flexible. It allows for as many features as you want to bring into your decision making. You can make it depend on other factors, world affairs, the weather. Very flexible. The downsampling is designed so that you understand which observations are significant and which ones are not, and the rest you throw away. And then you train your model using only the threshold observations with perfect look-forward capabilities, optimizing your objective function, whether it's expected return, Sharpe ratio, you name it. Okay? That's how it works. This will be very useful for you. I mean, you will do your own because you have your own space. He's going to arbitrage, I don't know, some market, and he's going to. So make sure you also remember his name. But more important, make sure he remembers yours. Okay. Okay. This is one of the few published algorithms which is 100% machine learning based, which it has a chance of working. I actually don't know if it works. I haven't used this myself. Okay, I know Marcos has used this. He uses, I'm sure, a version of this, and it has all of the ingredients to be significant because it, in my opinion, it ignores information that will be redundant. It makes a very efficient use of information that will be useful. It is very well adapted to how financial markets work, where a lot of what happens in the financial markets is really just noise. That's the downsampling part of the algorithm to realize what's important. And then when you figure out what's important, you have some hope that you can create a labeling system that if you're right 51% of the time, you come out as a winner. You don't have to be right 100% of the time. Okay? All right. So this is the CUSUM methodology. I have some more things for the other there's other types of labeling you can do, dynamic labeling. I'm happy with what I've done. I'm not going to do any more of those. If you're interested in this, I refer to you to his book, Machine Learning in Finance. I believe this is the first chapter in his book, or it's towards the beginning. Okay. Okay, I'm going to. So this was. I'm just going to move forward. I am not going to do this. All right. Oh, this has some Python code there. You have it in the notes. I changed the notes slightly from what I shared with you yesterday. I did not upload them to the website yet today, but I will be doing that shortly. Okay, and this is how it looks in practice. If this is the actual stock price now, this is not a ticking balance, this is the stock price. This would be the times at which I select the price as being relevant. These are the price points that I will use to train my unsupervised machine learning algorithm. And then, as you can see, the choice of the points which will be used for training is very inhomogeneous in time. And this is in my opinion, one of the unusual and attractive fundamentals for this methodology. That it tells you which price points to use to train your algorithm and which ones to simply ignore. Okay. So this is Mark. All right. Great. Okay. So that's the end of that. Now I go back to where I was before. Yesterday I showed you the. By the way, this algorithm that we developed here could be done either for long hold or sell, which could be short. My instinct tells me that this will be good for long trading. Short is slightly different, and I don't know if it would work on the short thing. So let's say that this is something that will be useful to us for long only portfolio construction. Okay, then we saw how shortening stock works. We saw that yesterday, and all of this brings us to so we went through that yesterday. We went through the short squeeze of Volkswagen. Okay. And where that takes me now is between the end of yesterday and the beginning of today, we have seen how we can make decisions to buy, hold, or sell, which could be also aligned with these decisions to short your portfolio. When you put it all together, there's something magical that happens if now you have a portfolio that you're allowed to go short. There's a big difference between portfolios in which you're only forced to be long, or those where you can be long and short. We already saw some of that 2 days ago now, because if you have a portfolio consisted only of long positions, then we saw that you're going to be attracted to be very close to the first eigenvalue anyway. So what you're going to do is going to be very similar to whatever the index does. It's very hard to get any performance which is different from the index. And that defines most of the financial funds that exist out there. As you know, most of the funds are mutual funds or similar. The real magic happens when you can bring short positions into the portfolio, because by bringing short positions into the portfolio, you eliminate your dependence on the first eigenvalue, and now you have really access to the returns which are uncorrelated to major market directions, and then you become an alpha producer. Okay, so by allowing your portfolio to include negative positions, then you become an alpha producer. How does that work? Okay, so I have here an example of a portfolio, which is a typical long-short equity portfolio. Let me walk you through it. This is a portfolio. It is a very slight modification of a portfolio we had in our books many years ago, and it contains all the interesting characteristics. The characteristics of these are as follows. I have the ticker symbols of my companies here on the right. Okay, some of these companies don't exist anymore. This is a very old portfolio, like that Walter Industries doesn't exist anymore. Not in that ticker is different. So if you're trying to understand what some of these ticks don't exist anymore, or maybe now they represent even different companies. I don't know. But that's not relevant. That's not important to us right now. You will still have some that you recognize: Apple, Citibank, Dell, Google. Okay, that we have enough that we recognize. Then there's a label, whether it's a long or a short. It's right here. Okay, that's the number of shares that I have. They are most of them positive, except a few of them which are negative. Google is 100, but then it's a short. As you can see, it's on the short there. And looking at the stock price, you can see how old this was. I'm guessing this was from 2010, maybe, something like that. Doesn't matter. The interesting part is when you go to the value of the asset, that's where you can see the longs and the shorts. And you see that most of my positions, all except 3, are long positions. Only 3 of them are short. Let me walk you through them. The first is my Google short. This is it's called a single name short. We already saw yesterday that there is a very specific risk that we take every time we short a stock, which is a risk we don't have when we go long a stock. And that's that up movements in a short stock can be very deadly. A stock can go up 4 times in a day. And if you are short that stock and it goes 4 times in a day, then you are out 400%. Your losses have infinite liability. Okay, so they are much riskier from that perspective. Whereas if you own a stock, the most you can lose is everything. If you're short a stock, you can lose more than everything. And for that reason, single name stocks, they tend to have less size than longs. This is very typical. Here we see that the short position on Google is about 1/10 of my regular long position. You will have portfolios where the size of the longs and the shorts are almost the same. If you see a portfolio like that, that's an indication that this portfolio is traded very frequently. And that short is not going to be there more than just a few minutes. Okay? But if you see a careful manager that sizes its shorts at a small multiplier of the longs, that means that this is a portfolio where the turnover, where the typical trade is longer than a few days. Holding a short for more than a few days contains risks, which is that the stock, something happens and the stock just goes and explodes on you. Okay, takeovers is a very major source of risk for shorts. We saw yesterday the example of Volkswagen, the short. It didn't take a very major, it was only a 30% buy on it was they were only buying 30% of the stock, and the stock went up by 300%, right? Okay, I will take just a few more minutes. I'll set you up with a portfolio, and then I'll explain to you the magic that happens. Let me just finish the explanation of the portfolio, then we take a break, okay? So that's my single name short. Of course, Google is not going to go up. It's not going to be bought over by someone. It is very stable, but still, I did it there on purpose so that you can see the reason for the smaller size on the shorts. Everybody who holds positions for more than a few days will do that. The next one is my index short. You can see this very large negative position on a certain security. The security happens to be the SPY. This is the ETF that tracks the S&P 500. So this is a market hedge. This is all of the 500 largest companies in the United States put in the New York Stock Exchange, put into my portfolio as a short. That short, that single name short, does not have the same risks as a single stock short, because the market is not going to be bought over by someone. You know, extraterrestrials come and they buy the whole S&P 500 at 3 times the price. It's not going to happen. So what the manager is doing when it's doing that is it wants to bring the entire market exposure of the portfolio to zero or close to zero. You can presume that the sum of all of the long positions is going to be about $14 million. So you're taking a $14 million short to have a net zero or very small net zero. Now, this number does not have to be equal to the sum. This is just a portfolio manager decision. How much of the long exposure wants it to hedge? Okay, and that's what it decided to hedge. We're going to see how this is done in a few, actually after the break, in a few minutes. Okay, we're going to see how these numbers are calculated. And the last one that I have is it's an index short. It is still a fairly large position. It's as large as most of my long positions. But if you notice, it's the QQQQ. This is the ETF that tracks the NASDAQ index. This is very typical. You have a certain amount of technology stocks in your portfolio. As you can see, you have Apple, you have Dell. So a way to hedge that would be, well, a little bit comes from Google as a technology hedge, but it's very small. The rest you're going to do with a broad index short, because indices are a lot more stable than individual names. Okay, so that's the how you construct a typical long-short portfolio, and the why. In this case, the manager wants to have very small net exposure to the portfolio. The manager has a view that there's lack of market direction or does not want to participate in the market direction. So this can tell you that this portfolio is going to be orthogonal to the first eigenvalue. It's going to be focused on the second, third, does not want market direction. And the hedge is that with a single name, which typically is an alpha producer. For some reason, you think that Google is overpriced, and that's why you go short. That is typically not a hedge. Okay. It could be a pairs trade. You could be doing a trade which is Google against Apple, but it's so unbalanced that this would just be an opportunistic short as an alpha capture to obtain some return from your decision to be short Google. And the rest is just long positions, thinking that these stocks are the best in the market and they're going to outperform the S&P 500. And that's what they are there. You don't know that any one of them, you don't know that Bank of America is going to go up. You don't know. But you're making the bet that it's going to go up more than the market. That's where you're long it and short the overall market. Okay? So that's how a portfolio like that is built. We're going to take a break now. And after the break, I'm going to answer a very important question, which is, how much money do you need to support this portfolio? Or in reverse, if I give you some amount of money, how do you decide whether to put $1 million there, 14 million short, 425, or what? We're going to discuss the sizing of the portfolio as a function of how much money you have. We'll answer that after the break. 15. So at this time, I want to ask the following question. Very important question. And the question can be actually asked in many different ways, but I'll start with the simple one. Let's say I have this portfolio here. How much money do I need to trade this portfolio? Let's make it very simple. Let's say that the total sum of the black numbers is 15 million. And let's say that the total sum of the red numbers is 15 million. Let's say I'm 15 million short, 15 million long. How much money do I need to trade that portfolio? Do you know the answer to that question? Who here trades on your own? You don't trade? Okay. What do you think the answer is? Paula? Zero? Okay.
I don't know the exact amount, but I assume you would need like some sort of margin for the shorts.
Okay. Give me a number.
50%.
How much?
Maybe 50%.
50%? 50%. Okay, so it's zero. So give me a number. Don't say percent. Give me a dollar number.
15 million total long and short.
So it's 15 million long, 15 million short.
Maybe like
3 million? You think 3 million total? Yes?
Sure.
Okay, so I got 3 million there. I got a zero there. Anybody else? Say something.
15.
15?
Yeah, I think it's
15? I got two 15s. I got a zero. I got a 3. No one says 30?
I would go.
You will go with 30? Yeah, okay. I want to answer that question. It's a very important question. And I want you to understand the significance of that. But I'm not going to do it by answering this question. I will answer another question that will, once it unfolds, you will see the correct answer to this. Okay? So I'm going to take this into a much simpler situation. Let's say that I only have two stocks, A and B. I want to, each stock is only $100. I want to buy 9 A's and I want to short 9 B's. I want to answer the question, how much money do I need for that? It's the same, right? It's just easier.
1800. 1800.
Well, it could be 1800, it could be 900, it could be... And to make it even more realistic, I'm going to change the question again. And I want to make it very practical. Let's say that I have $1,000 to invest. And I would really, really like to have 9 long A's, because I think A is a wonderful company. And I would like to short 9 B's, because I think B is a bad company. Or, better yet, I don't know if A is a good company or B is a bad company, but I know that A is definitely better than B. I give you a natural trade we did. There was a time when the trade that we did was we were long Apple, short BlackBerry. Do you know BlackBerry? You're that old. You know BlackBerry. There was a time when the chatter was Apple versus BlackBerry. The question was keyboard, no keyboard. You know, BlackBerry had a keyboard, had a physical keyboard, and that was addictive for many, many people. And when Apple came out with their non-keyboard phone, the iPhone, there was like, in the investment world, it's like, BlackBerry is the way to go. You know, you need a keyboard. This Apple keyboard only makes mistakes. This was an investment conundrum. Apple versus BlackBerry. And there were people who were long BlackBerry, short Apple, and there were people who were long Apple, short BlackBerry. We were long Apple, short BlackBerry. And the thesis was very interesting. The thesis was that the keyboard is, if it's useful at all, which now you would know that it's not useful, but if it's useful only for people in Western countries. In Asia, people, you know, a keyboard, why do you want a keyboard, right? So from day one, Apple had an Asia-focused marketing strategy, and that's why they didn't have the keyboard. And for us, that was the deciding moment that that was the way to go. But BlackBerry was very, very powerful. And Barack Obama, the president of the United States, insisted in keeping his BlackBerry when he became president, which was a big issue because BlackBerry was a Canadian company. And you couldn't have the data of the president of the United States in a Canadian server, right? So it was a big thing. So let's say, I think A is better than B. I don't know if, you know, A could go down, but I know A is better than B. That's why I want to do that. And this is very important, that when we do a trade like that, this is called a pairs trade. When I do the pairs trade, is not, sometimes it's not because I think A is going to go up or it's going to be a good company. It's just better than B. It's a relative value trade, which today we may see more relative value trades. Okay, in any case, for whatever the reason, and I may have my reasons to go long A and short B, and we don't care about that. It could be the result of my CUSUM algorithm. So I have to go long A, short B. Okay, fine. But now my question is, what happens? And I'm not asking how much money I need. I am already telling you I have $1,000, right? And the question is, can I do this with $1,000? And to make it even more realistic, I'm going to say that I was right. And after a year, A goes up by 10% and B goes up by 5%. Why was I right? My thesis was not that B was going to go down. That was not the reason I was going short. My thesis was that A is better than B. And indeed, in a year, A does better than B. A could have been down 5% and B down 10%, and I would still be right. I didn't buy A because A is going to go up in price. I did my pair trade because I think A is going to do better than B. So that's great. I'm going to make some money. But let me examine for you what happens when I do this trade with $1,000. And for that, I'm going to do the accounting of my portfolio accounting, very similar to the accounting we did on day one. It's just that in this case, it's an accounting for a pairs trade. So I'm going to assume zero interest rates, zero. So in a year, I have $1,000 there. If you have interest rates of 3%, you just add 3%, but I don't want to bother with that. That's not the point. I will have 9 long A's. That means that I'm going to spend $900, and the $900 in a year will be worth $990. Okay, so I will be using the 1,000 for that, and then in a year I'll have that. But then I'm going to be going short B. Short B is going to give me $900, and then it's going to cost me $945 in a year. Okay, that's my accounting. And something very important, which will be part of my story, I want to tell you a couple of stories today, very interesting stories that I want you to remember. And this is a very important one. I'm going to pay 1% for the privilege of going short. I did this description of how we do shorts yesterday very quickly, and this was hidden under the rug. But when you do a short, when you borrow stock, you have to pay a rental for that. It's like when you rent a car, you have to pay something per day. There you have to pay a percentage per year. The percentage is not always fixed, it changes. Sometimes it's very cheap, it's like 30 basis points. Most of the time it's 30 basis points. It's fairly cheap to borrow stock. Sorry, 30 basis points on top of the ongoing interest rate. So 30 basis points is what you pay, usually the broker, not the owner of the stock, for the privilege of the land. You don't care who gets the money. But sometimes you pay 100%. We have had short issues where we paid 100% borrowing fee. That's a lot of money, right? Why? Because sometimes some stocks are very hard to borrow. And then the broker says, if you really want to borrow that stock, you're going to pay 100% or 200%. He said, you know what? I don't care. I'll do it. It's a very important cost. So here I'm taking a number which is very easy to work with, is 1%. It's a little bit high, but you have higher numbers than that. But 1% is very convenient for us to do calculations. So I'm going to assume a 1% borrow rate. So I'm going to pay $9 to the broker for the short that I'm going to incur. And that gives me, at the end of the year, that I will make $36 net, which amounts to a 3.6% rate of return. Okay? Yeah, understand the accounting of this particular situation. So it seems I can do the trade. It seems I can do the trade mostly because the $900 short will give me $900 in cash. So suddenly I have $1,900, which suddenly allows me to buy 9 A's and have some money left over. Okay? And the result is I have 3.6% rate of return. Is that clear? Before I move on, because I'm going to now move to the next scenario where I will trade with only $500. I'm not going to give you the answer until the next slide. I want to create 3 scenarios so we understand what happens with 3 choices that we make. Now, but before I do that, let me ask you a question. How do you like my 3.6% rate of return for that trade? I want you to be critical about that. By critical, I don't say something bad. I mean, think about it. What do you think? Is that good? Is that bad?
I think it's a bit not very good.
You think it's not very good? Okay. Then give me something better.
10%?
10%. Why 10%? Why not 100%? Why 1,000,000%? What are you basing your answer on?
On nothing, actually.
Okay, so no, but that's good. I want you to learn. I want you to learn this thing. Okay, so you're just saying a number, said 3%. No, 3%. No, I don't get out of bed for 3%. Okay,
I mean, you have a lot of risk. You risk like 1,000 cash for like only 3.
You think so? You think I have a lot of risk? Okay, I'm going to argue with you. Okay, let's argue. Okay, what did the market do?
It went up
By how much?
by 10% on the long, on the A.
The market, the index. What did the index do? I would say 7.5. Right? I only have 2 stocks. I only have 2 pieces of information. 1, 10, 5, 7.5. Yes? Okay? That would be my guess. That would be your guess. So the market went up 7.5. And I went up 3.6. So I ask again, what do you think of 3.6, knowing the market went up 7.5? You continue to think it's bad. Say something.
Yeah, I mean, you could do better.
You can do better. Okay, good. What do you think, Ilya?
Taking into consideration that it's 7.5, the index, and it's more safe.
What's more safe? The index is more safe?
If we're talking about like a lot of a broader, let's say, sense of investment,
Okay.
maybe you will reduce the risk of, at least it's less riskier than having just 2 stocks.
So the index is less risk than the 2 stocks.
It depends on the index for sure, but
The index is A plus B, and this is A minus B. So we only have 2 choices. There are only 2 stocks, right? You think the index is more risky?
It-
Just say,
it was
don't,
the- yeah.
look, you have, just say something, okay? Yeah, you think the index is more risky. No, you think the index is less risky. That's what you're saying. This is more risky than the index. Is that what you're saying? I want to have some debate. I need some debate now. I want you to.
I mean, isn't it like it depends on the correlation between the two stocks you're holding them? So if you're long and
Now we're talking. Now we're talking. Depends on the correlation. Exactly. So, okay. So, what do you think the correlation is?
I mean, they're probably like decently highly correlated. I mean,
One. If I have to guess, I would say it's one, right? Stocks are highly correlated. We saw that yesterday. Stocks move together up and down, right? So now back to, so I want to have some debate. What's more risky, this portfolio or the index? We're going to learn a lot with this example. I can tell you that. I can see that, yes, and you will change the way you think about investing. Tell me, what do you think is more risky? Okay, you don't want to, you are now either scared or you want to.
no, I'm not scared.
You're not scared, then say something.
Thinking, well, if you say like the index is containing both of them, then I see that one rose 10 and the other 5. That I think it's safer then for the index.
The index is safer.
I guess. So.
Okay, so who thinks the index is safer? Anybody thinks the opposite? You think?
I mean, probably you're in an equal size position in 2 trades, like you pretty much lowering the overall volatility because you're like.
Okay, so you are telling me,
Go in the same direction.
so which one has less risk?
I would say the 2 stocks.
The A minus B. Okay, so we have only 2 choices, A plus B, A minus B, okay? So you think A plus B has less risk, you think A minus B has less risk. Great. Alvaro, what do you think? Alvaro is your name.
Yeah,
Oh, you're hesitating now.
I mean, I was gonna say when you are going long short, you have less risk. I was thinking of the cases where you make money or you don't make money, like on the.
We're talking about risk now.
I mean, the long short has less exposure, so it has, in some sense, so it has to be less risky.
Less risky, A minus B or A plus B?
A minus B is less risky.
Is less risky. Okay, Paula.
I would say that A minus B is less risky if they are completely correlated, but if they were completely uncorrelated, then I would say
If they're completely uncorrelated, then it wouldn't matter. It would not matter. But stocks are correlated. If I have to, again, I didn't give you any numbers, okay? We're doing magic. We're answering questions without numbers. But stocks are highly correlated. So if I have to pick, I would say the correlation is like 80% or more. Yes?
I mean, but doesn't it also depend on the type of risk? Because like if you're
Yes.
versus the idiosyncratic.
Correct. You can have lots of risk. You can, yes. But you see, I know, you're right. But we're answering this question without any data. Zero data, right? Just with our intuition of what we know about stocks. So we know stocks are highly correlated. So if I have to assume there, if you have to make an assumption, the correlation is 1, right? So which one of A minus B or A plus B, which one has bigger risk? A plus B has higher risk. Ilya, you're convinced now? No?
Yeah.
In fact, how much higher risk? Now I want to ask you a question that has actually, without data, and I ask you a quantitative question. I remind you one thing. We saw this number, I think it was on the second day. I remind you that we saw an eigenvalue decomposition of a variance covariance matrix for a stock market. There were 10 stocks. You don't remember, but I do. But I give you a number from there. I remind you that the first eigenvalue was 50% of the trace. So the first eigenvalue was 50%, and the second was like 10%. So the first eigenvalue was 5 times the size of the second eigenvalue. That number we have seen. It was in my lecture notes of 2 days ago. The first eigenvalue is 10 times the value of the second eigenvalue. You think, what do eigenvalues have to do with this? Well, they have to do because eigenvalues is the way you think. Yes, it's the way you think. So if my first eigenvalue is 5 times the size of the second eigenvalue, what's my first eigenvalue here?
Like going equal on the
1, 1. That's my first eigenvalue. I really would like everybody to understand what I'm saying. I don't get to read the faces of the people on Zoom, but I read your faces here. And I think we're on the cusp of doing some really very serious learning. You know, trust me, I've done this many times. So please stay with me. You'll remember, you'll know what an eigenvalue is, yes? Yes? Okay. Okay. I don't know if you know how useful they are, but today you're going to learn. They're wonderful. So the first eigenvalue here is A plus B is 1, 1. For stocks, it's always 1, 1 because they always go up and down together. So the first eigenvalue is 1, 1. That's the index. The second eigenvalue, there's only one choice. What's the second eigenvalue? There's only one choice. Your linear algebra. Bring it, find it there in your brain somewhere and bring it back.
Eigenvalue or eigenvector?
Actually, eigenvector and then eigenvalue.
It has to be orthogonal or so minus 1, 1 or...
Exactly. So it's this portfolio is the second eigenvector, right? This portfolio is the second eigenvector, and what's the eigenvalue? Let's say that is 20% of the largest eigenvalue, just like we saw a few days ago. Let's say, why not? The first eigenvalue is, say, 1. This will be 0.2, because that rhymes with what we saw 2 days ago. Certainly lower. Maybe it's not, the size of the eigenvalue is related to the daily volatility, and that's usually in the basis points. So it's really 10 to the minus 3. That will be the size of the largest eigenvalue, and then the second eigenvalue will be 2 times 10 to the minus 4, something like that. But the thing is that we don't care about the actual number, we care about the relative size, because it's the relative risk that we want to understand. So if one is 1, the other one will be 0.2. So that would mean, from what we saw a few days ago, that the risk of this, the volatility of this, which is the eigenvalue, will be about 20% of the risk of the index. I hope I didn't lose you. I lost you. I know that. You're looking at me like, whoa, what's going on, right? Yes, you are. Good. So what's going on? So this is what's going on, okay? I remind you, okay? I'm trying to explain something to you, okay? All right. Eigenvalues and eigenvectors, they are like, you're in complete control on eigenvalues and eigenvectors, yes? Right, okay. So I remind you that a few days ago we saw that for a stock market, the first eigenvalue is about 5 times the size of the second one. So let's say that it was the same thing here. It's actually, it cannot be, it's too much, not 5 times, it's more like maybe like twice. But it doesn't matter, like just go with that number because that number we saw. Okay. So if the risk of that portfolio, A plus B, the risk of the market is 1, the risk of this, which is the second eigenvalue, the risk will be 0.2. The risk is the eigenvalue. And here by risk, I'm talking about the variance because it's the only thing I have. I cannot do a conditional value at risk because I have nothing. I have no data series. So it's all intuition. It's all what's in my brain. Yes? And if that numbers are exaggerated, if I say that it's only 30%, then this has 30% the risk of the index. It's something like that. But certainly the risk is lower because the second eigenvalue is lower than the first eigenvalue. We know that. For stocks are correlated. The first eigenvector, the index, has an eigenvalue which is about twice to 5 times the value of the second eigenvalue. Okay? The return is a half. So for sure this is a better investment. The Sharpe ratio is higher. Because if the return is a half and the risk is a third or even 20%, it's better, right? Even if the first eigenvalue, no, the first eigenvalue cannot be the same. Even if the second eigenvalue is a half of the first, then they're comparable. But from a risk-adjusted perspective, knowing what we know about eigenvalues and eigenvectors for a stock market, I would think that this is a better return than the index. Sorry, I disagree with you. But do you understand what I'm saying? Of course, I don't know the numbers. You get me the numbers, and maybe you're right. But this is how we think, and we think without numbers. Always think without numbers. Okay? All right, who didn't understand this? Please say if you didn't understand. This is not hard. It's intuition I'm trying to develop. The intuition I cannot prove to you. I just need to explain. I need to go to your brain. Okay? I know that some of you understand, but the rest of you I'm not sure. Yes?
Yeah, I might have like a marginal question. So
Of course.
But doesn't the eigenvalue of the index, isn't the eigenvalue of the index smaller in case we have a smaller index, like
Yes.
number of stock?
It is you mean the relative value, the relative size? Yes, you're right. Yes, you're right. And that's why I don't know that this. Normally in a stock market, I would expect this to be maybe a third of, or maybe a half of the one in the index. That's what I'm going with the 20% because that's the number that we used a couple of days ago. But you're right. There we had 10 stocks. Here we have 2. So the ratio for the eigenvalues will be lower in that case. Yes, you're right. Actually, that's a very important question, It's a very difficult mathematical question. If I give you a random, if you like theorems, this is a beautiful theorem. It's a conjecture. I don't know the answer. I suspect what the answer is, but I don't know. You have a random matrix, a random covariance matrix of dimension n. What's the expected ratio between the first and the second eigenvalue? That's a beautiful, beautiful homework question, if you like math. And if someone knows the answer to that, please send it to me. I would love to know. Okay? Actually, I should ask ChatGPT. I haven't done it. I'll ask later, during the break. If you like math, this is a beautiful math question. It's pure math, like theorem proof. Yes?
Just because of weird. Is your intuition that it scales with n?
Sorry?
Is your intuition that it scales with n?
My intuition that it scales with the square root of n. But I don't know if I'm right. That's my intuition. But I don't know. But it's a very good math question. All right, let's go back to the world of investing. You understand what we're saying? All right, so we got 3.6%, and we see, at least I think I managed to convince you that it's not so bad. And certainly this portfolio has less risk than the index. That's for sure. Because in particular, if A had gone down by 5% and B by 10%, the index went down by 7.5%, and I'm still up 3.6%. So if you have any doubts that the risk is less, think about that, right? The most likely scenario, after the market goes up, the rate goes down. If it goes down, I win, and the index is down. And then you would probably even agree with me, right? Exactly. But That's the most likely scenario. In market goes up, market goes down. Beyond that is that A goes up, B goes down, or B goes down and A goes down and B goes up. Oh, then I'm screwed. So the 4 events, only one is going to hurt me. But in the others, I make money. Okay? All right. Sorry, back to what I was talking about. I'm going to extract a lot of juice from this example. Okay, so I'm going to spend a lot of time on it. I don't care how much time I spend. We're going to learn so much from this. You will see. Okay. So let me continue then. Let's say that I want to do an aggressive. I call it aggressive because I'm going to dare buy the same stocks, 9A, 9B, with only $500. That some of you may think I cannot do that. I already need 900 just to buy my long A's. But then I'm saying, yes, you're right. But I'm also doing 9 short B's, so I get $900 in cash. Why don't I use the $900 from B to buy A, and the 500 I don't even need. So I can do that. I still pay $9 for my short interest. And I make my same $36, which now translates into a 7.2% rate of return. By the way, 7.2 rate of return compared to the 7.5 of the index, now it's pretty good. You all agree, even you agree, it's pretty good, yes? Yes? Well, maybe you think, you're convinced that the index has more risk than this, right? Or no? That the index has more risk than A minus B. Yeah. Okay. So I think we all agree that this is definitely a better trade, right? But since I don't need my $500, why don't we just do what I call the impossible trade? Don't be misled by the word impossible. You can actually do it, okay? I call it impossible. You see why. Why don't we do the impossible trade, in which case we make $36 for free? It's an arbitrage. We get an infinite rate of return. So I'm going to give you with 3 choices. And I'm going to talk about them. And then, by the way, I'm going to give you the answer to the question later. But I want to first build this tension. I want to consider 3 possible options for trading. And I want everyone to pick yours. Even those online, I welcome you to pick the conservative, the aggressive, or the impossible trade. Everybody picks one.
Can we combine them?
No. It's to make my life very difficult if you combine them. Okay, when you leave this classroom, you can do whatever you want, but don't combine them here. 30% of that. No. I want to know. I want to know how you think. That's all I want. Okay. So are you all ready to vote? Are you all ready to vote? I want to see what people vote online. It's not a vote, by the way. This is it's just a choice that you're making. Where's the chat? All right. So I got one person choosing aggressive. Great. I love it. One person conservative. Great. Here, please raise your hand. I want to know who chooses the conservative trade. So Cyprian, right? Cyprian, Alvaro, Ines, right? Ilya, conservative trade. Eduardo, yeah, conservative trade. Okay, I'll try to remember. Okay, all right, good. Who picks the aggressive trade? Paula, I still don't know your names. I need to learn your names. Okay, great. I got it. Who picks the impossible trade? Damn it. No one picks the impossible trade. No one. Why? Huh? Can I have someone please pick the impossible trade? Can you change? I need someone here. Okay, Alvaro picks the impossible trade. Thank you. I'm going to call you John. There's a reason. I'm going to call you John. Okay? You're John for a few minutes. Don't mind. Okay? All right. So let me tell you why. I need Alvaro to be called John for a few minutes. The reason is this. Now I have to tell you a bit of history. In 1998, something very important happened. I want to tell you what happened in 1998. Have you heard of this name, Monica Lewinsky? No. You have heard of Monica Lewinsky. Okay. Have you heard of Bill Clinton? Bill Clinton, yes? Yes? Okay. So what's the relationship between Bill Clinton and Monica Lewinsky?
Like secretary or
Hmm?
like a secretary or something?
She was an intern, but there was some sort of an affair between Bill Clinton and Monica Lewinsky that caused Bill Clinton to be impeached by Congress in 1998, in the first week of August of 1998. That was the same week that Russia defaulted on their bonds. That was, you don't remember this, but there was this guy called Mikhail Gorbachev. He drove the perestroika through the Soviet Union, which had collapsed, and then Russia emerged as a new country, and they were welcoming the capital markets and they issued bonds. And in 1998, they defaulted on their debt. And then they devalued the currency, which usually is the other way around. It was a shock for the markets. That was a double whammy for the markets. Bill Clinton gets impeached, and the same week, Russia defaults on their debt. It was horrible. The credit markets dried up. Like there was no, there were these big trading floors, hundreds of people talking on the phone, yelling all the time. Quiet. At 11 a.m., no phone was ringing. Eerie. There was this fund called Long-Term Capital Management. Have you heard of that fund? No? Okay, so that was a fund that had two very famous directors, Myron Scholes and Robert Merton, who had won the Nobel Prize for Economics in 1997, the year before, and were selling the fund because the fund was doing something very interesting. What the fund was doing was that. Not with stocks, with fixed income instruments. See, with stocks, a trade like that is very aggressive, but for fixed income instruments, it's not so much, because this is what they were doing. Okay, now A and B are no longer stocks. A and B are bonds now. Let's say A is a 30-year bond, paying a coupon of 4. And B is a 29-year bond, paying a coupon of 4, sold at a discount. One is what's called an on-the-run bond, a lot of liquidity, lots of good stuff. Yeah, people buy, people sell. But the 29-year bond is a bond that some pension plan somewhere said, I want to get rid of these bonds for whatever, and no one wants to buy them. They're off the run. So the portfolio manager of long-term capital management, called John Merriweather, goes there and said, oh, I'll buy that bond. It's cheap. But I buy that bond by what? By short selling the 30-year bond that everybody's trading. You understand what I'm saying? So it's a very similar trade, not stocks, very similar trade. And was buying. But of course, when you do a bond, you make money on the difference. And the difference is very small. Very small. So to be worthwhile for your fund, you need to use a lot of leverage. Leverage, by the way, back to the first lecture, where I go. I need a little bit more time. Okay, I need to get to this is the bad moment to have a commercial. Okay, so the amount of money you make is very small. So it makes sense for the fund if you can do that by financing the long side. So you're Merriweather, you're John, and you go to the bank, see me, I'm Goldman Sachs, okay, and say, I want to do this trade. And everybody knows you, by the way, you're so famous. You were at Salomon Brothers, very successful trader. Everybody made so much money with you. You made money for your client. You're just very famous. You're a rock star. You are the bond rock star in New York. So you come to me and said, I want to do that trade. And by the way, everything there is billions. Okay? And I look at that and I said, oh, sure, John, of course you can do that. Right. But John, there is no cash in your account. And then you say, cash? Why do I want cash? So, John, and then you say, Goldman, why would I give you cash? Look, I always win. Don't worry. You collect your $9 billion right there. I'm exaggerating a little bit. It wasn't, it's more like million. Okay? You collect your 9 million, just be quiet. And I'm Goldman and I go, sure. Because I know that if I say no to you, you're going to go to Merrill Lynch and they're going to give it to you. 1998. Actually, this started in 1990, in the 90s, 95, something like that, okay? But there's a reason why I want to say 1998, that just wait, because something else will happen in 1988. You understand? And you're great, because you're making great returns because of that. And by the way, in this case, I could be wrong. A could go down and be up, but in this case, you just wait 30 years, because these are bonds, they're guaranteed to pay, right? Right? They're guaranteed to pay. Yes, they are. You just need to hold them, right? Every 6 months, you receive some dividends and you pay some dividends and you collect a few pennies. And if those pennies are for free, great. That's what you were doing, essentially. I'm exaggerating a little bit. But this exaggeration you will understand. Now, the thing is, you not only did that with me, you then went to Merrill Lynch. And you never told them that you already have this deal with me. You did the same deal with them. Same conversation. John, no cash. Cash? Otherwise, I go to Goldman. Eh? Oh, no. I'll do it for you. $9 million, I keep it. Understand what I'm saying? Now we understand how the brokers work. That's how they make money. And we understand how the John Merriwethers work, how they make money. You understand? And by the way, then you go to Morgan Stanley, and then you go to JP Morgan. $5 billion of that. So you did that, if that's 900, that long-term capital, they ended up controlling $1 trillion worth of bonds, notional. So what did I say, billion? Yes, I was right, billion. Yeah, billion. Right? You understand what I'm talking about? I want you to understand this. This is fantastic. Fantastic. But then, damn Bill Clinton, damn Russian bonds, market dries up. And what happens? The underrun bonds, the ones that I went long, okay, they end up going down in price because no one wants them, right? And now I'm Morgan, no, I was Goldman, right? I'm Goldman, and I call you John, said, your balance is very negative now. And then you say, don't worry, just wait. Because what's negative is on a mark-to-market basis. But you know, and I know, that if we wait, price will converge because they're bonds. There's no default, it's just that the price, the mark-to-market is suddenly very much against you. And your account is very sharply negative. You understand? But then I said, just wait, this is not a stock, it's a bond. They're going to come back. But at that point I said, I'm really worried. And I called the Federal Reserve. I said, I have a problem. The Federal Reserve is my boss, right? I report into the Federal Reserve. You've seen risk management, you know how it works. I said, I have an issue. I said, no kidding. I just got a call from Merrill Lynch and JP Morgan and Morgan Stanley. We all have an issue. And I go, John, what have you done? I said, oops. So we get together in a room and we figure it out because we have $1 trillion worth of bonds that we need to somehow protect. Because, of course, if people outside know that there's blood, we're all dead. And $1 trillion was a lot of money for the Fed back in 1998. Now they have what, 30 trillion? Print a few more money. But back then was a big issue. Understand? You understand this? Okay, you understand so much now. You just became adults, financial adults, if you understand that. So the result of that was, actually, there was something very ironic, that on January 1st, 1998, Basel I was just implemented in all the banks. You're familiar with Basel I? That was the risk management, the first wave of modern risk management, right? But only for market risk. This is not market risk because this is under credit risk. Why? Because they were not my bonds, they were your bonds. So the regulator said, damn it, we thought we had the solution to the 1987 market crash, but now we have a new one. So let's hurry up and do Basel II. This was the event that created Basel II. So since Basel II, you cannot do this. Before Basel II, this trade was possible, and in fact, John did it. But after Basel II, this trade is impossible. You've seen Basel II. You've seen risk management? Yes? Okay, so this is exactly why Basel II exists. So under Basel II, this is an impossible trade. You cannot do that. Yes?
But what were the bonds they were buying? Like the only actual risk was default.
For the bonds?
Yes.
No, okay, yes, for the bonds, yes. No, but the thing is that the balance is very negative. The bank has to come up with that negative balance. And back then there was some sort of regulation. We didn't have Basel II, but there was some sort of regulation. And the balance was so negative that becomes apparent to my regulator. One thing is that my balance is low, or even, but if it's big, it's an issue. I mean, the bank, I get people in the bank calling me and say, what have you done? And they don't know who John is. So that account is sharply negative. It's $1 billion negative. At $1 billion, you can say, no, just wait 20 years and we'll get it back. That doesn't work. Right? That's how banks work. Are you all with me? You understand? You tell the historical moment that we're going through. It was a bloodbath. It was bad. It was bad. This whole thing actually exploded. This was unleashed in August, but it only exploded in October. It took 3 months. Like John was just swallowing this for 3 months because the markets didn't really recover very quickly, right? Okay, now, so back to our example, that's an impossible trade because now banks cannot do that. That trade has its own risk calculation, which the bank will have to respond to by sending money, their money, to the regulators, and they're not going to do that. They're not going to do that. So what banks do, and now we're going to come to the answer, okay? But I still remember I try to remember who the aggressive, and so only John is doing the impossible trade, okay? But I'm coming back to this, but I need to now tell you that because of Basel II, now any trade has what's called a collateral requirement, which what you were talking about. What's your name? Adam. Okay, so Adam told us earlier, he already saw this coming. He said, no, there's something called the margin account or a collateral requirement, which is when you do a trade, you have to put some money down. How much? Well, I'm going to give you the normal rule, okay? You can get exception, you can get a better deal, but a normal rule was that the broker will help you finance up to 50% of the longs and up to 20% of the shorts. But you have to come up with the collateral for 50% of the longs and 80% of the shorts. We're not surprised that the shorts require higher collateral than the long. We're not surprised. You have bigger risk, yes.
But didn't we say that futures can have almost if we use futures?
No, futures is different. Futures, because futures are different. Because futures are not securities. Futures are contracts. Futures have no value. And your margin is with the exchange, it's not with the bank. If futures and securities are regulated differently, securities are regulated by the Securities and Exchange Commission in the United States, and futures are regulated by the CFTC, the Commodity Trading Financial Supervisory Board, something, a CFTC. Okay? And I don't know in Switzerland and other places, I don't know how they are regulated, but they are different securities. And there the margin is not with the broker, it's with the exchange. But that's a very good question. The margin is different. Okay? We're good. Perfect. So what does that mean in our case? So in our case, let's do the calculation. How much margin do we need? The margin I need is $450 for my longs, $720 for my shorts. I get $900 in cash for my shorts, so I need $270 net. So I can do this trade with $270, which is great because it gives me a very nice accounting at the end of the year. I'm making 16 and a bit %. And to that, by the way, there's something called the variation margin, which is as A or B goes up and down, then you make or lose money. That gets added to the 270. So if A goes down and B goes up, you need more than 270. And if A goes up and B goes down, you need less than 270. Okay? Great, perfect. So now we'll take a break because we're ready for our next trade. When you come back, we're going to do a trade, a realistic trade. And the year will now be 2007, by the way, 2007. Okay? So what I want to do now is I did a poll, and some of you chose the conservative trade, some of you chose the aggressive trade, and well, you were forced to choose the impossible trade. What I would like to do now is I would like to propose, for those of you who chose the aggressive trade, if anybody would be willing to trade with $270. Would anybody be willing to trade with $270? You, Paula, will trade with $270. Anybody else? You, Lisa, right, will trade with $270. Anybody else? 2 is enough. 2 is enough. Okay, so with thank you for that, by the way. Okay, yeah, you're about to die. Okay, thank you for it. So this would happen in what's the risk if you trade with $270? The risk is that B goes up and or A goes down, and then you're in trouble. Okay. In fact, that happened there was, I'm exaggerating, but you'll understand what I'm saying. The world of investors out there is full of people who do all sorts of things, and those who squeeze their trade limits, they found themselves in August of 2007 in the following situation. So I have the two of you trading A and B with $270. 2007 was the year where the subprime crisis was initiated. Are you familiar with that? Yes? Okay. It's a very important history. You should know what happened there. And today with me, you will learn very much about what happened in 2007 and 2008. So in 2007, the subprime crisis was initiated around March of that year, 2007. And investors were very nervous because there was speculation that the credit bubble that had been built since 2001 was probably overstretched. And many of them had sent instructions to the big asset management firms for redemption of their assets. So I have money, so yeah, I want to sell, I want to sell, I want to sell. They were not rush sell orders. A lot of these funds, they have certain liquidity provisions. So you typically liquidate the sell orders by the end of the quarter. So let's say September of 2007. But the banks already had these redemption orders ready to be executed, but they were very large. And you know it's very hard to unwind very large positions, because if you do that, you actually affect the market. So banks were looking for quiet periods in the market to unwind their positions. And what developed was a need to unwind positions looking for quiet days. There was one very quiet day. Nothing was happening in the market. It was August of 2007. August is typically a slow month. And we noticed that because we witnessed this developing. And much of what I'm going to be telling you is just my own imagination as to what happened. Some of the things I don't have proof, but I'm pretty convinced that what I'm telling you was actually true. There was one day when a lot of our A's in our portfolio were going down, and a lot of the B's were going up all at the same time, which is very rare, all of them at the same time. That would be consistent with the following. If I am a big asset manager, and I also went to school with you, and we think the same, we buy the same A's, we sell the same B's, and then I have to dump a lot of them, then by me dumping A's and buying B's, I make the A's go down and the B goes up. But when that happens, right, and you say it doesn't make sense, well, it doesn't make sense, but it happened, and it was very, very coincidental. A lot of A's were going down and a lot of B's were going up. So when that happens, now Paula and Lisa, you are in trouble, because you have and it's not just the two of you, there's probably more. Okay, there's two in Zurich, but there's people in New York, everywhere. Now you get a margin call. This is what a margin call is, and this is what happens here. So I have a situation here where just they saw a one-sided move. That's all we need. And you're asked for money. You're asked for, say, $50, a very small amount, but you don't have it because you're fully invested, right? And by the way, you cannot call your investors and ask for more money. That will take months. So the only thing you can do is you can only unwind your positions. You can sell some A's, buy some B's, but either way, you have to unwind your portfolio. You have to start doing that. But the thing is that when you now start selling A's and buying B's to come up with the $50 that the broker requires, now Lisa is next and she has the same problem, even worse, right? Even worse. So this creates a cascade effect where a lot of A's are going down a lot and going down by a lot, and a lot of B's are going up and they go up by a lot. Now this gives an interesting opportunity. Who here had the conservative trade with the $1,000? You were one, right? So what do you do now? You have $1,000, ample margin, and you see that you cannot explain. All the A's are going down, all the B's are going up. Right? Who else had the conservative trade? Was it Eduardo? You? Okay, you went from. Okay. Of course. So that was because that's my intervention, right? So Alvaro was there too. What do you guys do? You wait. You always wait, but you pay attention. In fact, you call the broker. You call me. You call the broker, because the brokers are very good sources of information. What's going on? This doesn't make sense. This horrible company is going down. This horrible company is going up, this wonderful company is going down, what's going on? And then I say, well, I cannot talk to you right now because I'm very busy giving margin calls. I'll call you later. Exactly. Well, yeah, but then I know. I went to school with Paula and with Lisa, and I'm sure that they're getting a margin call right now. They're always very aggressive, right? You know that. And everybody knows everybody, and everybody. So crowded trades give rise to that. It's another risk factor that we haven't talked about, which is the crowding of trades. And it's something that investors need to be very, very aware of. It's very hard to be aware of that But it's one of the areas where data science is also helping us now, because you can have better access to understand who might possibly be doing those trades. Okay, and you want to avoid crowded trades. Now, for that, you need a very good database. As you know, trades are no one knows who is buying or selling unless you are in very big numbers. Then you have to announce, you have to disclose. But one thing which is now empowering a lot of the data-driven analysis for trading is your ability to understand how crowded some of these trades are. And you access data not to understand whether the stock is going to go up or down, but just how many people are long A, how many people are, and if you can, who are they? Because this could create an unknown risk to your portfolio, something that we haven't expressed, which is the crowdedness. It's part of another, you can think of it as a momentum trade, but it's a social network. And social networks are on the up now. We discuss that almost every day. So there's a social element that is making these risks, on the one hand, more prominent, and on the other hand, something that you can control using data techniques. But the data techniques is to understand how crowded the trade is. In any case, this will be deadly for you because you are forced to sell at a loss, and it's very hard to recover. Now, those guys, Eduardo and Alvaro, they're going to do nothing until they see that you are extinguished, that everything is over. And then B is very expensive. And then what they do is they maybe stretch their risk aversion a little bit, and they decide to buy a few more A's and short a few more B's, because you have lots of room left in your margin analysis. Okay? So because of that, one of the things to worry about, one of the risks that we have not discussed is the risk of a margin call. Let me just mention that briefly, because it's something which is also very much up our sleeve. The mathematics of this is very, it's very substantial. But we can actually calculate the probability for margin call. So let me give you a mathematical problem. A mathematical problem that I'm pretty sure that you know enough math to solve. So assume I have a certain portfolio with an excess margin equal to a certain number. So in the case of Paula and Lisa, it will be 0. Okay? For those of you, it will be like a lot. Your excess margin is $730 for you. A lot of money. Most of your $1,000 is excess margin. You're very far. So everybody will have different. You understand this, right? It's how much money you have that you don't need. Then what's the probability that you get a margin call? Let me assume that my portfolio is, as usual, we start with the Gaussian case. It's the one that we can solve. If it's not Gaussian, then you have to deal with something more complicated. But in the case of a Gaussian portfolio, if it has a certain mean and a certain standard deviation, what's the probability I get a margin call? So I have the formula there. I don't know if you've seen this formula before, but let me tell you where it comes from. This is math. I don't want to spend too much time on this, but I think it's math you have seen. Have you calculated the probability distribution of heating times? You've seen heating times for stochastic processes. You've seen that, yes? Okay. You know, or you may have seen that that Brownian motion has a heating time probability that you can calculate. You've seen that? Well, you haven't seen it, believe me. Okay, it's here. That's how I got it. This is some calculation that you can do. If your portfolio is Brownian motion, if your portfolio evolves over time as Brownian motion, in other words, if your assets are all Gaussian underneath the portfolio, then the heating time is something that can be calculated explicitly. So in this case, the question that you would be asking is, if I have a Brownian, I'll give you the math version of this. The math version of this is, if I have a Brownian path, what's the probability that at some point, that Brownian path hits minus A? because when it hits -A, you get a margin call. So that math problem has a solution. You've seen Brownian motion, everybody. Yes, you've seen Brownian motion. Okay, good. So again, I don't know if you saw this. It's not important that you saw that. This is called a heating time. This problem that I'm talking about has a name. It's called the maximum of Brownian motion. And the way you solve it is with a very fundamental result. It's called the reflection principle. Maybe even you have seen that. Sounds familiar, the reflection principle? Maybe? Okay. It doesn't matter. I don't need you to. I'm not going to teach you that. I just give you some terms in case they are familiar to you. So with that, I can calculate, and this is the formula I have. And this is interesting because this is another risk that we have not seen before. We've seen credit risk, we've seen market risk. What is this? Collateral risk. This is something which we haven't seen. So now I pose a very interesting problem for you. It's a new problem. We haven't seen this problem in this course yet. Decide for me an algorithm to tell me what your optimal margin should be. So in your case, you chose 0 excess margin, 270. You chose a lot, $1,000, $730 excess margin. Your performance is 3.6. Your performance is almost 17%. How do you decide how to optimize your margin? Understand the problem? This is a new problem. And it's a problem which is typically not discussed, but I want you to be aware of that. Yes? You can write it down, and when you can write it down, you can solve it. For example, you can do a Sharpe ratio type of calculation. In your case, you have a 17% return. But if I divide by the risk, whatever risk is, it's not standard deviation now. Your risk is infinity. You have a probability of 100%. So that's going to give you a 0 ratio. You don't want that. In your case, you have a 3% return, and then the probability you get a margin call is 0. So you have like no risk. It's a very big number. The Sharpe ratio is the wrong context to apply for that. Why? And another reason is that the Sharpe ratio, remember, was how we optimize your paycheck. Remember that? So now what you could do is you can reformulate the decision to choose your margin call by saying, what's my benchmark return? 5%, right? I want 5% return because then I make 1 million Swiss francs. Remember that contract? All right. So can you answer this question? And I give you this as you have all the ingredients that you would need for something like that. Can you answer this question? If your target return is 5%, you get 1 million Swiss francs as a bonus if you hit 5%. With mu and sigma as the defining drift and volatility terms for your Brownian motion, with $270 as your minimum margin, what's your decision for which margin to use? You understand my problem? Is it yours? Unlikely, because you're not going to hit 5% with 3.6, right? It's very unlikely you hit 5%. Yeah. But there's a chance because the portfolio distribution is Gaussian, and in your case, it's certainly not 270, because the probability you hit at 5% is going to be a 0. You're going to get a margin call. So that requires some sort of simulation, and that is something that you are able to do. Okay, so it's a different way of thinking, something that is very unusual. But that's how you would attack that problem. Okay? You understand what I'm saying? You would know how to do it if you had to do it, yes? You would know how to do it. Yes? Yes, everybody? These are real problems. These are real challenges that just come up as you are making these decisions. And this is all related to portfolio sizing. So now we could go back and look at my $15 million portfolio, and we know what the answer would be for how much money we need for that, and it depends on my risk profile or my risk aversion. So it was 15 million long and 15 million short, and now I'm going to need 7.5 million for the longs, and I'm going to need about 10 million for the shorts.
I have a question.
Yes.
The 5% is an arbitrary number, obviously.
Which one?
The 5% is an arbitrary number.
Yeah, yes. I'm just relating that to the exercise we did here 2 days ago. Yes.
Makes sense. My question was, but in reality, you always have this kind of number. You have to.
Yeah. You look at your employment contract.
Because does it ever make sense, for example, to calculate the marginal, let's say, value in terms of avoiding margin calls?
In your employment contract.
No, in general.
Yeah. See.
I understand that as an employment contract doesn't make sense because.
Right. Exactly. Yes.
You don't have a target, okay? So you are like, let's say you don't have a target, so it's outside of reality. But does it make sense to calculate maybe the marginal value of adding margin to your account in order to avoid like the margin call?
I don't understand.
Like, for example, if I had like in this kind of position, the difference, for example, behind having $2,000 margin instead of $50,000 margin, realistically, is different from adding, for example, $100 margin if you have 500 instead of.
No, I still don't
Okay,
understand.
let's say your margin is $500. Okay.
My margin requirement or my margin.
Like, yeah,
My margin requirement is $500. Okay. Yes.
adding $100 margin to this position to your margin. Sorry.
Adding 100.
So going from
Is that
500 to 600
sorry? Is that my available margin or my margin requirement?
requirement.
My margin. So my margin requirement, I don't decide, right?
Yeah, but let's say you decide like we are doing an exercise where we actually choosing like a riskier position.
Oh, you're telling me that I could increase the sizing of my portfolio to. Okay, I understand. Okay, so I increase the size of my portfolio to go from a $500 margin requirement to a $600 margin requirement. That's what you're asking? Okay, I understand now. Yes.
The asset to buy are the same, just to make it. Like the asset.
Yeah, it's just you're going to pay more to increase the margin, or no?
No, like in our case, maybe I got it wrong. In our case, we have the same asset, but we have different margin.
So are you talking about the A minus B or the original portfolio we had with 50?
A minus B.
A minus B. All right.
So we are getting 900 and 900, and
Yeah. Okay, and you have.
and we can do it with zero margin. Sorry, zero position, net position. Like putting $0 in it because.
Putting $0.
Exactly. We can convert with the
Okay.
impossible case.
Yeah. The impossible trade. Yes.
And then we have like we eliminated that. Now we have like the two other cases: the safety one, which I chosen.
That's right.
That safety one. which
Yes.
Someone else has chosen.
Yes.
And what I'm saying is that adding $100 just for safety, not buying any other asset. So make it.
But adding $100 meaning to the 270.
Yeah.
Oh, okay.
Yeah,
So
exactly, without
okay.
buying any other asset.
Okay, so you're saying, what if, so let me see if I understand. Your question is on the hypothetical that I trade with $370 balance in my account. So $100 excess margin.
Exactly.
Okay, I understand. $370 in the account, $100 excess margin. Okay, great. Yes. Now what?
The marginal value of adding this $100
Yes.
in terms of risk are different from adding the same amount of dollars in the safe position. Like if you already had a higher excess margin.
Oh, yes.
So what
Yes.
I'm saying is that
Yes.
do you actually ever solve this kind of problem by, for example, setting a threshold on the marginal value you acquire by adding?
On the marginal value, so in this case, there will be a marginal probability, right?
Yeah, exactly. So does it ever make sense or?
So I have to go from probabilities to values. I don't know how to do that.
Okay, maybe I have to think about it.
Yes, I don't understand. You're thinking about something, and I cannot even understand what you're thinking about. Okay. I'm sorry. I wish I understood what you're.
I'll check it by myself, and then maybe I got the wrong words or.
No, but if you got it wrong, then I need to make sure you understand. But I think you understand. Maybe you're thinking of the marginal. Let's not call it value. Let's say the marginal impact on your portfolio of, I say, if I have $100, if you have $270, $1 more give you a lot of safety, compared to, in your case, $1 more you don't care, right? So in their case, a dollar is very valuable somehow, compared to you. There's so much margin. Why would I want $1 more, right? Yeah. So that would be something. Is that what you're talking about?
Yeah.
Okay, then we understand. Okay, so, and in that case, what your interest is in attaching a value to the additional margin.
That's not a value, but there is up to a certain threshold where adding more, $1 more is gonna be more.
So for sure, the value of $1 to, I'm looking at the risky traders here, Lise and Paula. Adding $1 to their margin account has tremendous value, whereas yours. So if you look at the value of that, the value is, as that excess goes to you, is infinite. It's tremendous value. I don't know how to quantify that, okay? Yeah, but it's tremendous. In your case, it has like no additional value, right? So it's a curve, and then deciding what's the optimal point in that curve, right?
You ever heard this kind of?
Yes, but then you need the objective function. What are you trying to optimize? So if you have a curve, say this is my optimal point, what's your optimization? Let's say that the optimization is, I want to minimize the probability of a margin call. Then you're going to say, well, then have as much margin as possible. But then I lose a lot of return, right? Now you need to start to balance the return that you lose and the probability of that. And the Sharpe ratio is very good for that, because it divides one by the other. Here you cannot do that. You have to come up with a different. And that's why I said, let me give you another objective function, which is not a Sharpe ratio, is not minimize that, is maximize the bonus you make. And that's why I came up with that, because that one I can solve. That one has a solution.
Okay, this was the point. Like, I wanted to understand, like.
Okay, if I set that objective, which is maximize the probability that you make £1,000,000 Swiss francs bonus, if that's what you want, that problem has a unique solution. And you can decide your margin, excess margin, that optimizes that. And that's not hard. You can do that. Yes?
Yeah, sorry.
Okay, so that is, but you see, it all depends on the objective function. I need to have the objective function that has a solution. The Sharpe ratio doesn't work here. And that's why I like the employment contract perspective, because that is, first of all, a very realistic objective function. Almost everybody has it, because almost everybody works for a salary, and the salary typically includes a bonus component, and that will tell you what portfolio you should have. Back to day one, when we had two columns, the investor column and the manager column, right? In the investor column, you have to take certain considerations, and that's where we don't know what the objective function is. But on the manager column, we know, because that compensation structure is something that we can optimize, and we have a non-trivial solution. Yes. What's important in this discussion is not what the solution is what is how you think about it. Always make sure that you know what the objective function is. And always be aware of what risks you have and your decision variables. Investing is always the same exercise. And I'm just going through this example so that you see an increasing collection of decision variables, an increasing collection of risks that exists, and then you can build that into your optimization engine. Okay? Okay, all right. So I have a feeling that we're going to get a bell in 12 minutes. What I'm going to do now is I want to talk about bonds. I want to show you how we can do, because there's going to be some very interesting discussions about this. So I'm going to talk about, I'll call it convertible arbitrage, but I'm really talking about how the world works, okay? More than just a particular trade. So let me say something about a convertible bonds. I don't know how much you know about this. So let's start with a very simple question. Everybody needs money. We agree? Everybody needs money. People need money. Governments need money. Companies need money. I'm going to focus on companies. So no people, no government, companies. If you're a company and you need money, you want to expand your Swiss operations to Germany. What do? You need money, what's the first thing you do? As a company? Exactly. You issue bonds. You go to the bank, try to get a loan, okay? You try to get someone else's money. You issue debt of one type or another. I'm not going to distinguish between loans, bonds, lines of credit, all the same thing. You always work with someone else's money. Great. And that works sometimes. Sometimes it does not work. What do you do when it does not work? When you cannot, you go to the bank, you issue bonds, people don't want to buy them. What do?
Equity.
You issue equity. Okay? Now let's distinguish, let's make sure that you understand. This is not here because I assume you know this, but I want to make sure that everybody understands this. This is very basic corporate finance. What's the difference between bonds and equity? For the issuer, a bond is better because it gives you all of your upside, right? All of the upside is yours. When you do great and your company flourishes around the world, you just pay what you owe and the upside is all yours. The bad thing when you issue equity is that you give up the upside. And that's why companies like to issue bonds or debt rather than stocks. Now, if you are the counterparty, if you are the lender, what's the good thing about a bond? Safety. I have to pay you back. If you are a shareholder, you have no safety. If my initiative in Germany does not work, my company cannot survive, you lose everything. Whatever assets I have, my machinery, my trucks, my buildings, go to the lenders. They don't go to the shareholders. But the upside is all yours. So it's a risk trade. Bonds have certain good things, stocks have certain good things, and they're different, both for the buyer as well as for the seller. Okay, what if bonds don't work and stocks don't work? This is financial engineering. What you do is this. You're the company. You're the one who needs money. So you don't get to pick. You don't get to pick what's good for you. You have to pick what's good for them. So what I have to do is I have to see if I can come up with something which is the best that bonds have and the best that stocks have. See if I can have an instrument that contains the best of both worlds. And I give that to you. Of course, by giving that to you, it's the worst of both worlds for me. But I need the money, so I don't have a choice. What is that instrument which is, for you, the best of bonds and stocks? A convertible bond. It's a bond that I show it to you. It's a bond. It has its coupon payment. It has its notional, this and that. It has the guarantee that I pay you back. So it has the safety. But then you have the option to turn it into stock. She said, oh, it's great. I lend you, something goes bad, I take all your machinery that you bought with my money, and at least I get some of it back. And if things go well and it works, oh, great, I don't want this bond, I want the shares now. Okay, everybody understands that? These are convertible bonds. They are very interesting securities, and as we're about to see, they can be used for many things. And I want to use this as an example of it's actually an option. The reason they have this interest is that we can manage the optionality to, they say convertible arbitrage. Arbitrage is making money for free. And we already discussed that sometimes that term is misused and it's not making money for free. It's making money with a lot lower risk profile that you would otherwise have access to. And the reason is that these things tend to be so good for the buyers that sometimes they become investable instruments that you can use. Now, I want to explain to you what it is. I want to go through but I want to tell you the story I will tell you at the end of this. How convertibles change history. It's two stories. This is at the end of my notes, so when I go to that, I'll just go quickly, but I'll tell you now, I want you to be motivated to understand this from the right historical perspective. The first company that was very successful using these convertible bonds was a company called MCI. You probably don't know who they are. It was the first it's an American company. It was the first company when the telecommunications market was deregulated in the United States in the 70s or so. It's the first market that challenged the monopoly of AT&T in the United States. A small company, the typical American success story, started very small and grew very fast. And the growth that they did was through convertible bonds. They had a very clever scheme to issue convertible bonds, repay the debt, issue convertible bonds, and they grew and they attracted a lot of money and they became a very, very big company. Okay? Now, that's not very interesting for us. There's another example that's far more interesting for us. I think the lessons we'll learn from that are greater. And that's what happened in 2008. We talked already about the subprime crisis of 2007. It was very painful for me to live through those 2 years, but I learned so much. And now I try to bring a lot of that learning to you. You have the advantage that you get to learn without having to have lived through the brutality of those years. But I had to live through that. I learned a lot of things, and I'll try to share some of that with you. Okay? It's very, very good. And by the way, there's going to be a lot of reflections about regulation that I will also try to get you to learn. 2007 was when the subprime crisis was unleashed. We already talked about that. And then on August 13, there was this event in the markets where Paula and Lise lost their management company because they had a small margin. All right. But the big thing didn't happen in 2007. That was just a preamble. The big thing happened in 2008 because all of the banks in the world, not just the banks, but all of the banks in the world, insurance companies too, and were undercapitalized. There was a lot of very toxic financial products that were created, which we may see in this course. Normally, I was planning to show you, but we will see. I'm not stressed by that right now. A lot of products were created, and banks ended up realizing that they did not have enough capital. So the banks needed money. They started to realize they needed money in 2007. And what they did is, as you told me, issue bonds. They issued bonds, and very quickly that stopped to exist. I remember interest rates were 3%. I remember there was a bank issuing bonds with a guaranteed yield of 25%. No one wanted them. 25%. No one wanted them. Okay? So what do you do then? Well, actually, all banks had to do that in 2008. As you may remember, all banks, what they had to do is to issue stocks, and they were issuing stocks. and they were issuing stocks, and they were collecting a lot of money by issuing stocks. And then a new news would come out, and then they realized they had to issue more stock, and the stock value kept on plummeting and going down. That means that if it goes down, you have to start issuing more stock, because to issue stock at this price, great, but if you issue stock at this price, you have to issue a lot more stock. Your existing shareholders get diluted, and people say, what's going on? My God, this and that. Okay? So at some point around September, that stopped working. I will come back to September 14, 2008, after we go through the convertible bond description, how it works. But in September 14, 2008 is when the big event happened, which is when Lehman Brothers went bankrupt. Lehman Brothers went bankrupt, and everybody thought they were ready for that. That was Hank Paulson's biggest mistake. That was the chairman of the Federal Reserve Bank. He thought everybody was ready. No, they were not ready. There was one company, one big company, very quiet, AIG, American Insurance Group, who had issued credit default swaps on Lehman Brothers. You know what a credit default swap is? Credit default swap is a contract that will pay if the company defaults. And they had we're taking a break now, okay? But I need to finish this. They needed a bailout package of $80 billion. People thought $80 billion was a lot, okay? $80 billion, and they had 24 hours to come up with it. Why? Because they had essentially a margin call of $80 billion, essentially. And that was on September 15. And that was terrible for the banks, because then they saw that issuing stock was not enough anymore. This was a big event. And then they had to resort to issuing convertible bonds. And it would have worked if it was not because the regulators did not understand what a convertible bond was and the effect it had on the market. But you will understand that today. And that's what I will show you. You will see convertible bonds as a very interesting investment instrument, as a very good instrument for capitalization. But in understanding how they work, you will understand the mistakes that were made in 2008 by the regulators and how that actually precipitated a lot of the crisis of 2008. So that's coming after the break. 15. Convertible bonds, we went through why they exist and why they are good for us. I've already said this, I can go beyond that. And I want to talk about a particular trade. I want to go through it. There's one trade that we're going to be doing. I'm going to use with very simple numbers. I'm going to assume this. We have, there's a bond out there. It's a convertible bond on a company, and the bond sells for $80. That already tells you something. A bond selling for $80, that's a very big discount. So the company is trying to give you a very, yes.
Like 100 is the nominal?
Yes,
Oh.
yes. Usually $100 is the notional, yes. So it's a bond sells for $80. It's a 20% discount. So a 20% discount is a very big discount. It's like, you see, investment grade, below investment grade. It's already stressed. Okay, it's a distressed convertible. The company has a stock. The stock trades for $7 a share. Interest rates are 4%. Now I cannot assume zero. I'm going to assume 4% for the interest rates and a $4 coupon payment for the bond. So the bond has a coupon payment that matches the ongoing interest rate. And I'm going to assume a convertibility feature to the bond, which is that bond holders can exchange the bond for stock at any time for 10 common shares. You can exchange your bond for 10 common shares. So when you buy the bond, you don't exchange immediately because the bond is worth $80, and if you exchange for shares, you only get 70. But if the company does very well, then you take your bond and you're going to convert it into shares and you make a lot of money. And if the company doesn't do well, as we will see, if the company doesn't do well, then well, the bond will give you a recovery rate, and that's worth something. I'm going to assume a recovery rate of 50%, which is the average value of recovery rates across the industry for default companies. Okay? Okay. So very simple assumptions, very simple assumptions. At the end of this section, I will show you a very complicated convertible trade. It was the Citibank convertible trade of 2009. But for now, we stay with something very simple. And we're going to understand this bond by doing scenario generation. We haven't done that yet in this course. So I'm gonna learn how to do scenario generation with this example. Okay, I haven't done Monte Carlo either, but I'll tell you Monte Carlo, I assume you know, in the context of this. All right. So my first scenario is what I call the calm scenario. Nothing happens. And this is the trade that I'm going to do. So let's go through this very slowly and carefully. I bought the convertible bond for $80. That's line 1 of my slide. And a year later, the bond is still $80, like nothing happened. Now, I made a decision. My decision was I'm going to hedge my bond, because if it goes, the company does badly, the bond could default. I'm going to hedge my bond by doing something very extreme. I'll explain to you why I did something very extreme. I want to short 10 shares of the company as a hedge. It looks weird, right? It's okay, stay with me. I short 10 shares of the company. That gives me $70 cash and a liability for 10 shares. So I write the liability as minus 70, but the 70 it gives me, which is cash, I invest in a T-bill or some risk-free investment. You could say it's a checking account. It doesn't matter. That's my trade. The $80 I have, I buy the bond, I short sell 10 shares, gives me a liability of 10 shares and $70 in cash, and I invest the $70 in cash into a treasury bill or some zero risk investment. Footnote, if I asked you to do a leverage trade, now you know how to do that. You can do a margin calculation requirement, you can do a probability of a margin call. We've already seen that. What we saw for stocks works for this too. But now I don't need to focus on that. I need to focus on scenario generation, which is one thing that we haven't seen. And I want to do it in this context. Okay? All right, so if nothing changes in a year, my stock, which is $70 short, will still be $70 short in a year. So I owe 10 stocks, has exactly the same value. My T-bill, however, will give me a 4% interest rate. So it's going to be $72.80 because it gives me $4. So it gives me 4%. And the coupon payment is $4. So I get an additional $4 from the coupon payment. This is the financials in a year. If nothing happens, everything stays the same. I have to pay fees. What fees do I have to pay? I have to borrow stock. So I'm borrowing stock. I have to pay 4% plus 1. The borrow rate we're using in my course is 1%. I told you it's high, but it's easy to calculate. So it's 5. That means I have to pay the broker $3.50 for my short stock trade. Okay? Let's do the accounting. The accounting is I will make $3.30 net, which happens to be 4.125%. Okay, now before we move on, I want you to tell me, what do you think of this trade? Does it work? Is it good? Are you happy with that return? It's a 4% return. Notice that I wrote 4.1 as 4 plus 0.25. Why? Because 4% is what I get for free. So this looks like a very complicated trade just to get what I could get by investing in treasury bills only, right? So clearly, this scenario is not very attractive. Whichever reason the manager had to do this trade is not because of this. There must be something else. Let's see what that something else is. But we understand this accounting, yes? We understand the accounting. Great. Now, let me move to the next scenario, bankruptcy. Let's see what happens if the company goes bankrupt. If the company goes bankrupt, my bond is going to revert to its recovery rate. I'm going to assume 50% recovery rate. That means the bond becomes $50. So I've lost 30. My short stock position is now very profitable because I went from owing $70 to owing nothing. The coupon payment is, I don't get it because the bond is defaulted. It's already part of the recovery rate. The interest rates on the treasury bills are intact, so I get $72.80. I still have to pay my short selling fees, which, by the way, I'm very happy to pay this because this was my huge revenue generator. And I end up with a very nice rate of return. I make 50% return, more or less. Or I make LIBOR, risk-free rate, plus 46%. So that's 46% over the benchmark. That's pretty good. So now we understand why this trade was done. It's only one scenario. We're going to do more, okay? But this is only, we understand why this trade was done. So before I continue, I want you to realize something. Would you say that this, now that we've seen this, would you say that this trade was a convertible trade that used equity as a hedge? Or was it a short trade that used a convertible bond as a hedge? This is how I want you to think about this trade. Wasn't it weird that I was shorting 10 stocks? That was a very big trade. That was all of the convertibility of my bond. So what was actually happening, something very interesting, this was a short trade in disguise. It's not really a convertible trade, it's a short stock trade. We know that shorting stock is very risky. We saw that earlier today. So this was actually, it looks like, but it's not, it's just a short stock trade. Of course, you can say, well, if I short the stock, I would have made even more money. I would have made 100% of my money. So why go through the bond trade? See, now it flips sides, right? Well, we're going through the bond trade because imagine what happens if the company is bought by Microsoft at twice valuation. If that's the case, the bond now would be $140. Good for me because I would have lost 200% on my stock trade. Right? Now I owe $140 because I'm short 10 stocks. Luckily, my bond becomes $140 worth and everything else is the same. Everything else works very well. Not in my favor, but it works very well to protect me in the case the company is bought at 2 times valuation. You understand? So now it becomes clear that what looked like a convertible trade was actually a short trade with a hedge, and the convertible bond was the hedge to my stock trade. Okay, I think we learned something. Notice that in this case, I lost a little bit of money. I lost a few cents, or relatively speaking to the risk-free rate of return, I lost 4%. So I obtain 4% return less than the risk-free rate of return, which is 4. Okay? Is that clear? Okay, great. So let me continue, and I will have some other scenarios. We're going to do now a lot of scenarios. My first group, I'm going to do in groups. My first group of scenario is if things go not in bankruptcy, but worse for the company. So if they go worse for the company, I'm going to assume that my bond goes down in price, my stock goes down in price too. Bonds and stocks, they typically move together. But now hold on. This is my scenarios. But someone should actually do that slightly differently. And I'll tell you about that in a little later. Okay? So let's say that my bond goes from $80 either to $73 or to $70, and my stock goes from 7 to 6. So the company that goes worse. Well, I still get my $4 coupon payment because the company is not bankrupt. I get my 4% on my T-bill, and I pay my fees. Everything to give me a nice return if the bond goes down not so much. Again, the risk-free rate of return if the bond goes down a little bit more. But these are the scenarios which are favorable to me. And normally we will always get better returns if the company does worse than if the company does badly. Why? Because of my short position on the stock. And then I can go to the improving scenarios where I can just go through scenario where the bond goes up and the stock goes up from 7 to 8 in the case of the stock, and in the case of the bond either to 91, 88, or 85. And we go through the accounting, and we've done it before. We can see that, and we see, I went too quickly through that. So we see that we make a little bit of money. So we lose a little bit of money, not too much. This is clearly not why this trade was done. Just go there. Okay, all right. Okay, so this is how scenario analysis is done. Now, I made up these scenarios myself. In practice, these scenarios are made by a machine. You generate the scenario. You have information about the bonds, you have information about the stocks, and you generate these scenarios, including the takeover scenarios, which are not part of the typical Monte Carlo generation machine. Okay? So this is how these investment opportunities are done by generating scenarios. However, let me tell you how this thing would be done in practice. Now I want to look at a more realistic situation, which I already, in the first example, I told you the bond and I told you what I was going to do. Now I'm not going to tell you what I'm going to do. I'm just going to tell you the market conditions, and we're going to decide what our optimal strategy will be. The optimality of the strategy is what matters to us. I have my bond. It's today it's worth $80, and I hired a graduate from the University of Zurich who is going to do the analysis for me as follows. He's going to tell me that there's 3 possible scenarios for the stock, each of them with a probability of 33% happening. The first scenario is the stock goes up to $14, is bought by Microsoft, and then it doubles in price. And in case that, of course, the bond goes to $100, the bond, of course, you convert, is $140. And there's a 30% chance of that. There's a 30% chance that everything stays the same. The stock is at 7 and the bond is at 80. And there's a 30% chance that the company will go bankrupt. And you've analyzed the expected recovery rate, and it's going to be even lower than $50, it's going to be $30. So this is what analysts would do. They would come up with these scenarios and these probabilities. Most of the time, when people do convertible trades, they will consider scenarios like this. It will be much better if you have many more scenarios, which is going to be very difficult to do. People are beginning to do those things with large language models now. But I don't have anything to add because this is still developing and it's a very big mystery. I just want you to realize that a lot of these large language model scenarios are created. A lot of these scenarios today are created with large language models. I'm not going to tell you how that's done, because tomorrow I will be mentioning how we do something very similar using large language models, and it's almost the same. So today, let me stay with a very simple approach with human-generated scenarios. Tomorrow, we'll do something slightly more challenging. So with this in hand, the question I want to ask is, what should my optimal portfolio be? And I want you to tell me what the answer is. In fact, this is something that then you can write on your essay for today. You can take this scenario and figure out what the right answer is. What would you do?
In which direction I want
Yep.
to think?
To play around is always a good idea, no matter what you're talking about. Playing around is wonderful. It's completely underrated. Okay? Play around. It's always good. Play around. Let me do the following. Let me play around in a slightly disciplined way and see if I can do something interesting. So these are my three scenarios. I hope you can see them. They're a little bit small because I need some room to write something. And what I'm going to do is I'm going to introduce I'm going to do what mathematicians do. There's a variable here. A variable here that drives my decision making. Only one. It's very simple. Not a vector, not a just one. Which is I want to buy that convertible bond, but I want to hedge it. And I don't know how to hedge it. I don't know with how many stocks I'm going to hedge it. So I'm going to introduce a number x between 0 and 1 that says, of the 10 stocks the bond will give me convertibility, how many of them do I want to hedge? How many of them do I want to short? Okay? So x is a number between 0 and 1. If x is 0, that means I buy the bond and I pray. If x is 1, means I buy the bond, I short all the stocks, 10, and I pray that it goes bankrupt. Or I pick a number somewhere in the middle and I don't have to pray. I know I'm going to do good. And our objective is going to be to find that number x. And we're going to do it by building a very simple accounting form. Now this is parametric accounting. The parameter is x. So I have three scenarios. I already know I'm going to short x number of stocks. So we're going to do the same thing we did a few minutes ago on the three scenarios that are given to us. And we're going to understand how much money we make under each of the three scenarios as a function of x. And I have it here. You can see, right? My $80 today could become, and have the accounting down there, my $80 today could become 140 minus 70.7 times x under scenario 1, or $84 minus 0.7 times x in scenario 2, or $30 plus 69.3x in scenario 3. How did I get that? I know the value of my bond under each of the three scenarios. In the first one, the explosive success, I convert and it's $140 after conversion. In the others, is 80 or 30. I shorted x times 10 stocks. So in the first case, that the explosive success happens, I get hurt because my stocks will cost me 140x dollars, because x is the number of stocks that I shorted. If nothing happens, it's 70x, and if it goes bankrupt, I don't have to owe anything, so my balance goes to zero on the stock side. My investment in the T-bill is always the same, is $70 times x is the cash I get from shorting, goes at a 4% account. That gets me 72.x no matter what, 72.8 times x no matter what. The coupon payment is $4 except in the case of default. The fees are always the same, 3.5 times x. And then I just sum every column to get me the value of my worth under each of the scenarios. You know how to do that. And you can do very simple programming. Doesn't matter how many scenarios you have, you can just build this. And if someone gives you a scenario in a very big database with 10,000 possibilities, you can write code that will do that 10,000 times. That's not where the difficulty is. The difficulty is, what do you do now that you have all of this information? How do you take this information to make a decision?
I mean, I think you can just look at the numbers and see if you can be profitable above your initial investment. See if
Definitely, you can do that. So it goes to the playing around that you were talking about. Play around, say, right? And that will give you a good sense of what you will get. So you can do, as a function of x, you can do a simulation and get an idea, right? And then make a decision as a function of that. You're now very powerful because you know what results you will get as a function of your parameter. And this is single parameter x, okay? We have many other parameters. What if this, what if that, what if that? Or you can calculate the Sharpe ratio, for example. That's perhaps the first thing I would do. It's not that I would drive my decision making just on that, but this is very simple, because if I draw my Sharpe ratio as a function of x, I get something which is very revealing. My Sharpe ratio is very good if I short exactly 80% of the shares, 8 shares short. And that actually ends up being a very good trade if I short 8 shares. Yeah? And the Sharpe is pretty good. It's 1.7, almost 2. It's almost as good as the snow swap. It's very good. This time, I mean, you should still play around. You should still see what you get, okay? But from the Sharpe ratio perspective, I can tell you that if I short 8 shares, I will do pretty well. With this scenario given to me, of course, now this is the beginning of something wonderful, because now what you can do, say, well, what if I tweak the probability? To what extent my portfolio will be dependent on that probability or that probability? And now you can start to do sensitivity analysis, and now you're in control, because now you have all the information in front of you. And you will know what will give you money, how much, when, why, and this and that. Okay? And as I promised, I have here a convertible trade that happened in 2009, and I have 15 minutes left. And I think I'm going to use 15 minutes to tell you a wonderful story. A wonderful story. It has to do with this convertible trade. I have a lot of things here that maybe I'm not going to explain, maybe I'm not going to go through that. But I want you to sit back and relax and just listen to a little story that I want to tell you. The camera stopped for some reason. I don't know why. All right, well. I want to finish the story I told you earlier. September 14, Lehman Brothers go bankrupt. Huge blow for the financial markets worldwide, especially in North America. It was a North American story. AIG has to be rescued by the government, and there is chatter that Goldman Sachs and Morgan Stanley had issued credit default swaps on AIG. So if AIG goes bankrupt on Monday, then the big banks start to go bankrupt on Wednesday, Thursday, Friday, and it would have been a big, big, big disaster. So Hank Paulson is successful in raising money from US Congress very quickly to bail out AIG and make sure that it stops there. By the way, I think it would have been cheaper to bail out Lehman Brothers than AIG, but let the history books deal with that. We're not interested in that. What we're interested is in what happened after. On September 18, Thursday, there was a joint statement from the US and the UK regulator, then right after market closed, which banned taking short positions on bank stocks. What were the regulators thinking? The regulators were thinking that it was a bloodbath for bank stocks. So by preventing shorting of bank stocks, they were hoping that the stock would stop plummeting. Understand? Typical regulator reaction to a reality. It worked on Friday. I was at a conference, actually a Morgan Stanley conference in Athens, and most of the people there, they were short banks. And that day, Barclays Bank went up 200% at the open, just because of this. And they were all short. You could see that they were all play. They were losing money. It was very, very obvious. Fine. And it looked like that worked. But of course, what happened after is that the banks had to capitalize. And they were capitalizing themselves with convertible debt, as we already saw. And I have one example here. We just saw how people buy convertible bonds. How do you buy convertible bonds? You buy the bond. You hire someone from ETH or University of Zurich to do the scenario calculation. Pretty scary default scenario, as you can imagine, right? So for sure, the optimal X is going to be one in which you have to short, right? We just did it. X is not going to be 0 in 2008. You understand what I'm saying? Maybe it was 0.2, maybe it was 80%, maybe it was 100%, but it's suddenly not 0. But now the people that were the buyers of the convertible bonds, they could not short the stock because of this rule that came up. You understand? So what do you think happened? Sure, the stock went up for a while, but the banks were running out of capital. No one wanted to buy their convertible bonds because you couldn't short the stock. And that was terrible. That was terrible. Citibank, it was called Citibank in March of 2009, traded below $1 for a few minutes in New York. It went up and it closed like at $1 or 101. If it closes, I don't know for how long, below it's kicked out of the market. It's kicked out of the New York Stock Exchange. So it was like the bare minimum. Clearly, something had to be done. By the way, these banks are too systemic to the system. I mean, what they say, too big to fail. Well, that means that if these banks disappear, then transactions stop happening because they all go through those banks sooner or later, right? So, so there was a concerted trade. There was a concerted convertible bond issuance by Citibank. I have the details here, not important. And these convertible bonds were going to be bought by the Federal Reserve Bank. So the Federal Reserve Bank was going to be the buyer of these bonds, convertible bonds. Now, we went along with the Fed to buy these bonds, but we needed to hedge. And we found a way to hedge. And we have the prices of the stock here. Citi shares were trading, at the time that I collected this information, they were trading at $3.65 a piece. But they were at $1. This was in April, I believe. In March, they were at $1 for a few days. And we shorted, maybe at that price, $3 or $4, I forgot, maybe $4. We shorted because we had to. It's very painful to short at $4. I can advance you that when the trade unwound around July of that year, June, July, the stock was at 12. So we lost 400% on the short. We still made a lot of money because the convertible bond was very profitable. Understand? But guess who made more money than we did? The Fed. Because the Fed cannot short Citibank stock. They could not hedge this position. For political reasons, the Fed cannot take a short position on a bank stock. That would be bad. That would be weird, right? So this was a very profitable trade for us. It was a hugely profitable trade for the Fed. So this is interesting to understand not only how convertibles trade, but also how banks are bailed out. Typically, banks are bailed out like that. The ultimate buyer of convertible debt is usually the regulator or the government. Or, I know that here UBS was rescued several times by the government. I didn't look into the details, but I'm pretty sure it was done like this also, through convertible debt, which is issued, right? First bonds, no, then stock, no, convertible debt. And other markets participants, they participate, they buy the convertible debt, but they always hedge it because you just have to. And as we saw earlier, the decision on the hedge is given by a number X, which is the solution to a certain optimization problem. And only the optimal solution is when X is equal to 0, you would just buy the bond. But usually the answer is not. X equals 0 is never optimal, or hardly ever optimal. So that's why you almost always do that. Every time you buy a convertible bond, almost always you buy a convertible bond, you have to hedge a little bit. And I hope that's what you learned today. Looks like nothing. It's very important. It's very important. In some jurisdictions, you cannot do that. In Asia, sometimes you cannot short stocks. Or it's very difficult and you just don't do it. And then it's a naked convertible. You hope everything's going to be okay, but it's a suboptimal trade. If you want the trade to be optimal, you always will hedge. Doesn't matter who you are. If you're able to hedge, mutual funds cannot hedge. Sometimes mutual funds cannot go short stocks. It's not allowed in their offering memorandum. It's called a prospectus. We went through that the first day. If you cannot short, okay, just buy the bond. But if you can short, you will always short. So I hope you learned that today. And the scenario-based analysis that we do is like the one we did here, which is give me the probabilities. I work with 3 scenarios because I can do that by hand in front of you, but you know that you could do this with hundreds, thousands, it doesn't matter. Okay? All right, so maybe, I only have 7 minutes left, so I'm going to tell you a very interesting story that happened. Another one. Now I have 1 or maybe 2 stories. My first story is a very interesting relative value arbitrage trade that happened in the year 1998, 1999. 1999, January 1st is when the euro was introduced. The euro? And the euro was calculated as some of you, I don't know, you were very young, maybe you don't even know this, I don't know. But the euro was calculated through a political decision by the banks, in the central banks and the governments in Europe at a certain exchange rate, and I have the exchange rate there to the currencies that were there before the euro was there. And there was a decision. It was not decided by the markets. It was decided by the governments. And that's very important in the next story I will tell you if I have time. What happens is that towards the end of 1998, there was so much demand for the euro that the euro was trading above the value that have been declared by the banks, by the central banks of the countries. So what traders did is they short sold the euro and they bought the underlying currencies. And they just have to wait until January 1st, maybe January 2nd, to unwind the trade and make money. And the spread was very substantial. You can see you make like 2%, almost 2% in a few months. And if you can do that on a margin account without putting up the full notional, this was a very profitable trade. We understand that now because we understand margining, yes? But perhaps the best example is, let me just go quickly through this, to this one. This is the best example, which is very well known, but is very well misunderstood. And this is what happened to the British pound in 1992. You may have heard of that. And George Soros was one of the people who acted on that. So I'll tell you it's another very interesting story, and this, yes, 4 minutes, that's exactly where I need, and then I'll end. In the numbers that I showed you earlier for the euro, as I mentioned, these were politically decided numbers. They worked, but they were politically decided numbers. Now, prior to that, more than 10 years before that, in the 1990s, there was an interest. The euro did not exist. There was something else, was the ECU, the European Currency Unit, which in Germany is ECU, and that's why they had to change it into euro, because you couldn't call a currency with the name of a cow. That was the reason that we called them euro. It was called ECU for a long time. But the political intent was that Britain would join and the British pound would join. And for that, they created an artificially higher value for the British pound in that basket of currencies back in the 90s. That was the governments encouraging the British pound to be there, and they did it for that reason. But the observers, the outside observers, George Soros was just one of them. I knew many observers. Many observers were watching that and said, this is incorrect. So they did the trade, the same that we saw earlier. But the trade was against the British pound, going long the European currencies and going short the British currency because it was overvalued. You understand what I'm saying? Now, this has been labeled as an attack on the British pound. Okay, when I went short Citibank, it was not an attack on Citibank. It was just the optimal trade I had to do. You understand what I'm saying? You understand this now. You're good at this, right? So the optimal trade to do back then, when you know that the British pound is overvalued, you have to go short it. And then what? Just wait for convergence, because this price, it's not going to converge. It's going to have to be liberated. And the liberation happened in September 1982, when the British pound was allowed to float for free, and it dropped like 20% in a month. And of course, George Soros and many other people made a lot of money on that trade. But that was a trade screaming to happen, because it was a relative value trade. The British pound was artificially mispriced in that ECU currency that was being developed in the 90s. Understand? So this is good, because now through here you actually understand world history. You understand a little bit of what happened during the crisis. You understand a bit of what happened, how the euro was created, how the British pound was going to be in the euro, then not, and how it dropped, and then some people made money. Okay? All right. So that ends. I have many more things but I'll end it here. I'm done for this part of the trading strategies. We saw the CUSUM, but the real thing that I want you to learn is all these other stories that I told you, that put all of this finance in context and explains to you how things work, okay? What I will do tomorrow is science fiction, as I told you. I want to tell you how there are new financial markets being created, and I'll tell you about that tomorrow. There are new financial markets being created, which are going to be very different from the ones that we know from the 20th century. I will tell you about them. I will tell you the techniques that are needed to do them, most of which use AI. These markets are so, without AI, there's almost nothing you can do, and I'll explain that to you tomorrow. I will also use that as a way to explain some of the things that I have not done yet, but I will put in the context of the science fiction we will do tomorrow, like for example, the causality that you were asking me about. Okay, so that'll come up tomorrow in my attempt to understand the new markets, but then I will understand the old markets too, and we will be able to do microeconomics the right way. We will be able to do that tomorrow, but in the context of the science fiction. I hope it's going to be entertaining tomorrow. I'll try to make it entertaining. It's Saturday morning, you're here at 8, okay, or maybe no one is here at 8. I'll be here at 8. I'll try to make it entertaining. There'll be a lot of storytelling I owe you to do on a Saturday. But my hope is to get you ready, because what I will be talking about tomorrow is really your future more than my future. These things will be developing over the next few years. I don't know how long. Something I think is going to be pretty soon, and I will be part of that, maybe with you, or maybe not. Maybe you will be there, and then I'll be doing something else. Okay, but I think it's going to be useful, and I have to tell you what I'll be talking about tomorrow. I don't know anybody who perhaps even agrees with what I've been telling you. So you should know there will be some controversy or some weird stuff, but I'll share that with you anyway, because I always like to end with a peek at the uncertainty that we have in the future, which is really your present, right? Okay, we'll do that tomorrow.